Coffee imports entered the United States largely duty-free, but now some of America's top trading partners are facing double-digit tariffs on their imports, including coffee.
It may be too soon to tell how much more, but we've already seen people here at this coffee shop in Burbank having discussions outside about what this means.
That it's going to really affect the price of the coffee.
There's a moment in global trade where things don't collapse loudly, they just shift, and by the time anyone realizes what happened, the roots are different, the partners have changed, and the leverage is gone. And that's exactly what just happened in the coffee market. Because while the United States was trying to flex control, Canada quietly stepped into a position nobody expected it to hold. If you look at the raw numbers first, the story already starts to feel unusual, because in the first half of 2025 alone, trade between Brazil and Canada surged to a historic $3.4 billion in exports, up from $2.7 billion the year before, which is a 25% jump in just 12 months. And that kind of growth doesn't happen randomly, especially in a mature trade relationship. What makes it even more telling is that this wasn't driven by a single niche product. Although bullion gold dominated at $1.35 billion compared to about $765 million the previous year, there was also a strong rise in agribusiness exports like sugar, green coffee, and meat, alongside industrial goods like aluminum oxide, aircraft, and machinery, which means this wasn't a one-off spike. It was a broad expansion of trust and demand. And that word, trust, is really the center of everything here. Because global trade isn't just about who produces the most or who has the cheapest goods. It's about who you can rely on when things get unpredictable. And over the past couple of years, unpredictability has basically become the default setting. According to the Chamber of Commerce Brazil-Canada, even currency dynamics played a role, because although Brazil's currency appreciated against the US dollar, it still reflected a relative depreciation that made Brazilian exports more affordable for Canadian buyers, which quietly gave Canada an advantage at a moment when buyers everywhere were looking for stability in pricing and supply. Now here's where the timeline flips in a way most people didn't expect, because before Canada's rise in this market became obvious, there was already pressure building in the system. And it came from a decision that was supposed to strengthen America's position, not weaken it. The United States, under a strategy that leaned heavily on tariffs as a negotiating tool, signaled potential restrictions on foreign imports, including key commodities like coffee. And while the intention may have been to gain leverage over exporters like Brazil, the actual effect was the opposite, because it introduced uncertainty into a supply chain that depends heavily on consistency. Brazil, which is the world's largest coffee exporter by a wide margin, didn't need to wait and see how things would play out. Because when you supply a significant portion of the world's coffee, you don't scramble for buyers, buyers scramble for you. Instead of relying on a market that could change policy overnight, Brazilian exporters started actively diversifying their trade relationships, and that's when countries like China and major European economies stepped in with long-term contracts, locking in supply at a time when reliability suddenly became more valuable than price alone. But the real shift happened in a quieter lane, because while these major economies were making big, visible moves, Canada was doing something more subtle, but just as impactful. It was simply being consistent. Canada doesn't grow coffee due to its climate, but it is one of the world's most stable import markets, with high per capita consumption and a well-established distribution network. And more importantly, it doesn't tend to disrupt its import policies with sudden tariffs or political pressure, which made it an ideal partner at a time when exporters were actively trying to reduce risk. That stability started translating into real trade movement, and you could see it not just in the annual numbers, but in shorter-term data as well, because in the first quarter of 2026, Brazilian exports to Canada reached $1.83 billion, the highest value ever recorded for that period. While total trade flow between the two countries increased by 10%, driven largely by a 37% surge in Brazilian imports to $755 million. Even with that increase in imports, the trade balance remained strongly in Brazil's favor at $1.08 billion, reinforcing the idea that this relationship was not only growing, but also becoming strategically important for both sides. At the same time, Canada's share of total Brazilian exports climbed from 1.6% to 2.1% over the course of a year, and then held steady at around 2.2% into 2026, which might sound like a small percentage at first glance, but in global trade terms, that kind of movement represents billions of dollars and a significant shift in demand patterns. On the import side, Canada's relevance in Brazil's market also increased to 1.11%, indicating that this wasn't a one-directional relationship but a deepening economic connection across multiple sectors, including chemicals, pharmaceuticals, machinery, and mineral extraction. And then there's the part of the story that doesn't get as much attention but actually explains a lot of the momentum, which is how global supply chains have been reshaping themselves in response to geopolitical tensions. For example, disruptions involving the United States and Iran affected key logistical routes for fertilizers produced in the Middle East and Asia, which forced buyers to look for alternative suppliers, and Canada, with its relatively stable production structure, became a natural choice. Fertilizers alone accounted for about 44% of Brazil's imports from Canada in that first quarter of 2026, which shows how interconnected these trade flows really are, because a shift in one sector often reinforces growth in another. All of this creates a kind of feedback loop, where stronger trade relationships in one area make it easier to expand into others. And that's exactly what's been happening between Brazil and Canada, with agribusiness, mining, and industrial goods all contributing to a more diversified and resilient trade partnership. Coffee in this context becomes both a symbol and a driver, because while it may not represent the largest dollar value compared to gold or minerals, it plays a critical role in daily consumption and long-term contracts, which are essential for maintaining stable trade flows. Meanwhile, the United States found itself dealing with the unintended consequences of its own strategy, because when you introduce uncertainty into a market that relies on predictability, the immediate reaction is hesitation. And hesitation in global trade often leads to rerouting. American importers, facing the possibility of tariffs and policy shifts, struggled to secure consistent supply, which led to price increases and disruptions that filtered down to consumers, from rising cafe prices to more expensive grocery store products. Even when some of those policies were softened or rolled back, the damage had already been done in terms of perception, because once exporters start building relationships with alternative markets, they don't just abandon them overnight, especially when those new markets have proven to be stable and reliable. Brazil, having expanded its trade network with countries like Canada, had less incentive to return to a model where a single buyer held disproportionate influence, and that shift in mindset is often more permanent than any individual policy decision. What makes Canada's role in this story so interesting is that it didn't come from dominance or scale in production, but from something much simpler and arguably more powerful, which is consistency over time. In a global environment where supply chains can be disrupted by politics, conflict, or economic shocks, being the partner that doesn't create additional uncertainty becomes a competitive advantage in itself. And that's exactly what Canada offered. At the same time, domestic factors within Brazil also supported this shift, because there was already a broader trend of reducing dependence on any single export market, especially after previous experiences with volatile demand and pricing. The slight drop in Brazilian imports overall, from about 1.1% to 1% across multiple countries, reflects a more cautious and strategic approach to trade, where maintaining a positive balance becomes just as important as expanding total volume. And in the case of Canada, that balance remained firmly positive, even as overall trade increased by 16%. When you connect all these pieces, from the 25% growth in exports to the $3.4 billion milestone, the 37% surge in imports during early 2026, the 44% share of fertilizers, and the steady rise in Canada's share of Brazilian exports to around 2.2%, it becomes clear that this isn't just a temporary adjustment, it's a structural shift in how these two countries interact economically. And within that shift, coffee plays a surprisingly symbolic role because it represents the everyday impact of these larger changes, showing up in supply chains, pricing, and consumer behavior in ways that people actually notice. The idea that Canada has somehow replaced the United States in the global coffee market might sound exaggerated at first, but when you look at how influence works in trade, it's not always about total volume, it's about reliability, access, and long-term positioning. By becoming a trusted buyer at a moment when trust was in short supply, Canada effectively secured a stronger foothold in a market that the US had long taken for granted. And once that foothold is established, it's incredibly difficult to displace. And this brings everything back to a bigger question about how global trade is evolving. Because what we're seeing here isn't just a story about coffee or even about Brazil and Canada. It's about how quickly dynamics can change when one player introduces uncertainty and another offers stability. It's about how billions of dollars in trade can shift direction not because of a single dramatic event, but because of a series of small decisions that add up over time. And it's about how countries that understand this dynamic can position themselves in ways that don't always make headlines, but have lasting impact. So when you think about your next cup of coffee, it's worth asking where it actually came from, not just geographically, but economically. Because behind that simple product is a network of decisions, policies, and partnerships that are constantly evolving. Do you think the United States can regain its position in this market? Or has the shift toward partners like Canada already changed the game for good? And more importantly, which countries do you think will benefit next as global trade continues to rebalance in real time? Moreover, with the US economy weakening, Ottawa may have more leverage than it thinks, even if the tone coming out of Washington suggests otherwise. Because when US Trade Representative Jameson Greer floated the idea that Canada could accept higher tariffs in exchange for market access in sectors like dairy, and called it a helpful conversation, the real question becomes who actually benefits from that arrangement, especially at a time when the United States is dealing with deeper structural pressures that aren't immediately visible in trade negotiations. As Canada heads toward another critical review of the Canada-United States-Mexico Agreement, which governs more than $1.8 trillion in annual trade and anchors supply chains across energy, agriculture, manufacturing, and the auto sector, the assumption that the U.S. holds overwhelming leverage deserves a closer look, because beneath the surface of political confidence lies a fiscal reality that is becoming increasingly difficult to manage. A February report from the Congressional Budget Office highlights a growing imbalance at the core of the U.S. economy, centered on the relationship between economic growth, or G, and borrowing costs, known as R, which together determine whether a country can sustainably manage its debt over time. For years, the United States benefited from a favorable dynamic where its growth rate exceeded its borrowing costs, allowing it to expand debt without immediate strain. But that balance is now shifting in a way that could reshape its economic trajectory. The CBO warns that by around 2031, interest costs could overtake economic growth, pushing the country into a cycle where more and more resources are diverted towards servicing debt rather than supporting economic activity. A situation that tends to compound over time as governments are forced to cut spending and increase taxes just to keep up with rising obligations. The numbers behind this trend are already significant, with U.S. national debt exceeding $39 trillion and growing at a pace of over $7 billion per day, or roughly $2.6 trillion annually, while the cost of servicing that debt has climbed to around $970 billion per year, surpassing even defense spending and consuming about 13.8% of the federal budget. At the same time, the debt-to-GDP ratio has reached 124%, meaning the country owes more than the total value of its annual economic output, which historically signals increasing vulnerability, particularly when combined with rising interest rates. What makes the situation more challenging is that the era of cheap borrowing is effectively over, as debt that was previously issued at an average rate of around 0.9% over the past 15 years is now being refinanced at rates closer to 4% to 5%, reflecting a market that sees higher risk in U.S. debt than it once did. This shift alone significantly increases long-term costs, and when combined with the looming insolvency of major federal trust funds like Social Security and Medicare in the early 2030s, it creates a fiscal environment that is far less stable than headline economic indicators might suggest. In this context, the United States' increasingly aggressive trade posture begins to look less like a position of strength and more like a response to internal constraints, as policymakers seek concessions from trading partners to offset pressures they are struggling to manage domestically. From challenges to Canadian digital regulations to criticisms of provincial liquor systems and buy Canadian policies, the pattern points toward an effort to extract value externally at a moment when internal flexibility is narrowing. At the same time, there are early indications of shifting global confidence, with some central banks reducing their holdings of US dollars, and a growing share of energy trade being conducted in alternative currencies, trends that, if sustained, could gradually weaken the dollar's role as the world's primary reserve currency and make it more expensive for the United States to finance its debt. While these changes are gradual, they reinforce the idea that the foundations of U.S. economic dominance are not as unshakable as they once appeared. For Canada, this creates a more complex but potentially advantageous position, because leverage in trade negotiations is not solely determined by size, but also by timing, stability, and the relative strength of each side's economic fundamentals. As the next round of CUSMA discussions approaches, Ottawa may need to reassess how much it is willing to concede in order to preserve access to the U.S. market, particularly if the underlying balance of power is shifting in subtle but meaningful ways. The broader takeaway is that while the United States continues to project confidence in its trade relationships, the economic math tells a more constrained story, one where rising debt, higher interest costs, and structural fiscal pressures are gradually limiting its options. In that environment, Canada's position may be stronger than it appears, not because it has overtaken the U.S. in scale, but because it is negotiating at a moment when the other side may need the deal more than it is willing to admit. That's all for today. If you enjoyed this video, make sure to subscribe to the channel and turn on notifications. Thanks for tuning in, and we will catch you in the next one.